Hi, my name's Dave Kading.
And I'm Neil Brujic, and together we own a company called Optometric Insights.
Optometric Insights wants to accelerate your success both clinically and in practice.
Hello and welcome to the Between Two Temples podcast, a show focused on topics surrounding business, life, and optometry, where we try to fill the space between your temples with some valuable knowledge. I'm your host, Matt McNevich. Thanks for listening, and I hope you enjoy the episode. This podcast is brought to you by Optometric Insights. My guest today is David Baldridge, who works as a financial advisor and groups benefit broker under his own company, Bold Financial Services, based out of Toronto. David has strong ties to the ophthalmic community, having previously owned and operated a turnkey equipment rental company called MTSP that provided everything from OCTs and HRTs to YAGA lasers and fundus cameras for ODs and OMDs. He also owned and distributed his own line of private label contact lenses called PCL Contacts for several years, before selling both businesses and transitioning into financial services. David has been doing talks at the University of Waterloo for the last few years on everything personal insurance related. And today he shares with us what you need to know when it comes to protecting yourself and your loved ones for the long haul, as well as protecting your hard-earned income through unique tax-saving structures. This is an episode you don't want to miss, especially if you are just getting started in your career. So David, before we begin getting into the actual specifics of different types of products and instruments, I was thinking that you would be able to give our listeners a more general overview of how the insurance industry looks and who are the different players involved in it, so listeners can kind of put together, who they're working with and who's able to offer some of these products.
So with regard to the landscape in financial services as a sort of the bigger picture, it's very gray and it can be complicated. Financial services can include investments, it can include insurance, it can include financial planning, and everyone's out there offering different products and holding themselves out as somebody different. As a new grad or as a young professional, it's important to simply find the person that's right for you, that's a good fit. And in my opinion, the way that you do that is by asking a lot of questions and doing your homework, doing your research. Early on, it's probably more important that you have a sound insurance advisor, unless you're in a position where you're coming into some wealth or there's potentially an inheritance or you come from an affluent background where there's immediately capital to invest.
When it comes to finding, let's say, a broker to work with, where would listeners typically find such individuals? Are they working at banks, personal wealth management firms, insurance brokers? Where would you go about looking for one?
Well, I would say most of the time people find a trusted advisor through word of mouth, through other colleagues, friends, family. I would caution people about dealing with banks. The banks, certainly at the branch level, are not licensed to sell insurance products in Canada. In fact, they're not even permitted to sell at the branch level. I know that most of the professional schools have advisors coming to the schools, doing talks and educating students. That can be a good place to start.
Fair enough.
There's a lot of quality people out there, but at the same time, there are definitely some people that you really need to have your guard up with. What I would suggest to most people, as I said earlier, is to do some homework ahead of time and really ask some difficult questions. I would also caution people from working with, their Uncle Steve or their Aunt Mary. And not to say that Uncle Steve or Aunt Mary are not good, but when it comes to, in particular, disability insurance, and I'm sure we'll get into this a little bit later in the conversation, Matt, And when it comes to disability insurance, not all advisors are created equal. Disability insurance is a little bit of a specialized area. There are, I would say the vast majority, if I were to hazard a guess, probably 75-80% of advisors don't even sell disability insurance. They find it to be too complicated an animal. And when you're early on, disability is an important piece of the puzzle, and you want to be dealing with somebody who has experience not only understanding those products, but also experience in underwriting those products.
Let's say you're a new grad or a student about to graduate. Maybe you've been a couple of years into your career in practice. What are the type of different insurance instruments that everybody should be aware of? And can you give just a really basic definition of what each one is for?
Okay. So we'll start with disability insurance. In my opinion, for a new grad, young professional, this is the foundation piece for an insurance portfolio. What disability insurance is, in layman's, is in a situation where you couldn't work or you're unable to earn a paycheck, this policy will pay you every month, arguably until age 65, potentially for the rest of your potentially for the rest of your life. It's not based on work. It's based on your life. So this type of coverage protects you 24/7, 365, regardless of what you're doing. If you're unable to work, you'll receive a paycheck every month. So as a new grad or young professional, let's say in your late 20s, early 30s, you arguably have 35, 40 years ahead of you. Your biggest asset at this stage of your life is you and your ability to earn an income, and that's what needs protection at this stage.
So you would say that would be the first in terms of importance when you're starting your career?
Absolutely. I encounter young professionals in all different financial scenarios. Some individuals have been fortunate enough to graduate with little to no debt, lots of financial support from family, and other individuals I've seen coming out with $250,000, $275,000 in debt with little support. And I always say across the board, there's conversations to be had about the other insurance products I'm about to discuss, but when it comes to disability, whether you're 250 in the hole or whether you're ahead or even, it's a product that every young professional, in my opinion, should consider purchasing.
Oh, that's a great point. And now, if we were to move on to your number 2 insurance product that you would think comes next in line in importance, once you have the disability set up, you're comfortable with your plan, maybe you have a year, 2, or a few more in terms of practice under your belt, what would you be looking at as the next step in order to further protect yourself and set yourself up?
I think from this point forward, it's going to likely be on a case-by-case basis. And the reason I say that is because, if you're in your late 20s or early 30s and, you're married or you have children or you've purchased a home and have a mortgage with a partner, if mom and dad are on the dotted line or are on the hook for student loans, any of those things would probably trigger a need for some life insurance, because in the unlikely event that you were to pass, you wouldn't want to leave your loved one with a liability that wasn't looked after prior to your passing. There's also situations for life insurance where, let's say you have a family history and you're concerned about a condition presenting itself. Let's say you are about to take up a hazardous sport or activity, and you know that by, this is an extreme example, but if you're going to start skydiving or extreme scuba diving or something like that, it may affect your ability to acquire life insurance. So those are things that you want to think about perhaps sooner rather than later in terms of applying for life insurance. But I would say that in the average situation for young professionals coming out of school or the first couple of years out of school, that's not necessarily a concern. And I would typically speak about critical illness insurance as an option prior to talking about life insurance.
Okay, interesting.
And the reason why, I'll explain what critical illness insurance is in a moment, but the reason why I say that is because life insurance is protecting your loved ones after you're gone.
Mm-hmm.
It's not a living benefit. Let's face it, you're, to put it bluntly, you're dead, and your loved ones are receiving a tax-free payment. Yeah. Critical illness insurance is a living benefit. And the difference there is that what critical illness insurance is if you were to be diagnosed with one of approximately 25 different conditions, the big ones are heart attack, stroke, and cancer. They're the most common ones where 80 to 85% of the claims occur. Mm-hmm. But there is a list of about 25 conditions. You survive 30 days, and on the 31st day, a lump sum tax-free check gets paid to you. Remember, you're alive. It's a living benefit. Mm-hmm. And again, as a young professional, I think that adding that to your sort of defensive portfolio, your defensive arsenal, if you will, can be extremely valuable, because if you play this out with me for a moment, in the event of a disability, and let's say it was a serious disability, your disability insurance is going to cover you with regard to your monthly expenses. It's going to pay you a monthly amount every month until age 65 at minimum. Mm-hmm. But that's covering your rent. That's covering potentially your nursing, your insurance, your food, your clothing, etc. Mm-hmm. It's not covering any sort of one-time or big expenditures that you might have in that scenario. Let's say it was an extreme example and you weren't going to walk again and you needed to renovate your home. Mm-hmm. Where's that money coming from? Mm-hmm. Or let's say that you suffered a serious accident and you need some significant nursing care. Or you're looking to have mom or dad take 6 months or a year off work to come and look after you. Mm-hmm. Or even in certain situations, you're not happy, you've been diagnosed with something and you're not happy with the time that it's taking for the Canadian medical system to treat you, and you're looking to go down to the U.S. and receive treatment and pay out of your pocket more quickly. Mm-hmm. So that critical illness policy, that lump sum, gives you some breathing room, gives you some options. It doesn't solve your problems, but it does. How do I put it? Let's say that in a horrible time like this, it never hurts to have a bag of money dropped in your lap. Mm-hmm. Like I said, it doesn't solve the problem, but it helps to give you some options.
Interesting. And this is a one-time payment that you receive, basically. There's no ongoing critical illness benefits.
No, there are some policies that actually have something called a second event rider, mm-hmm. but not all the companies offer it. And that would be where even after one payment, let's say you were diagnosed with cancer and it triggered a payment, the policy stays in force. And if 5 years later you were to suffer a heart attack and survive, there would be a second payment.
Interesting.
Okay. But that's called a second event rider. But again, the disability and critical illness are living benefits. Mm-hmm. Okay? And that's why I'd say that more often than not, I speak to young professionals next about critical illness, because it's not about looking after others when you're gone. It's how you can help look after yourself and also ensure that you don't become a burden on the ones you love.
All right. So in your order of importance, setting up yourself in your career, you'd be looking at disability, then critical illness, and once those pieces are in place, then maybe looking at life insurance plans. And all right.
I think if we're generalizing, I would agree with that. But there's no specific timeline, because everyone's wired differently. Everyone has different values. And I have individuals who graduate from school and are pretty conservative when it comes to mitigating risk and want to lock up everything right away at a young age when they're presumably never going to be healthier,
Yeah.
and the insurance is never going to be less expensive.
Yeah.
And I have other individuals who will take the stance and say, you know what, I want to do the disability now. I think that's really important. But everything else, let's wait. Let me get my feet on the ground. I want to settle into my earnings. I want to settle into my expenses. Why don't we review in a year or two and see where I'm at? And I'm willing, I wouldn't say it's a roll the dice situation, but they're willing to wait and see for a year or two. The price is not going to go up that much in the first year or two.
Yeah.
And see where things are at then.
Yeah. Now, you do raise an interesting point there, and this is something that really opened up my eyes the last time you and I talked. When it comes to waiting, I realized that after speaking with you, there is a cost associated with delaying some of these things down the road, and it can get pretty significant when we're talking about, several years earlier versus several years later when it comes to setting up these types of plans. And also, you also mentioned during your talks when you used to come to the University of Waterloo, is that sometimes your health can change from year to year unexpectedly, and that can also jeopardize or impact in a great way some of these plans, what's available to you, and the costs. So can you give a little bit more color to what it might look like versus somebody getting this earlier on, late 20s, early 30s, versus somebody maybe who neglected looking into this and is pushing it off until maybe their later 30s, early 40s, and then just realizing that this is something they might want to have in place?
Good question, Matt. Good question. It's hard to put a specific percentage in place for increases, only because we're talking about different products, and there's a significant difference in price between males and females, and the increases are not linear. They sort of work in an exponential manner as one gets older. What I mean by that is the difference in price for any given product for a 26-year-old versus a 27-year-old would vary greatly as compared to a 36-year-old versus a 37-year-old. And even more so comparing a 46-year-old to a 47-year-old. So it's difficult to place percentages, but we can say that obviously every year that you wait to obtain an insurance policy, the cost generally goes up. Now, for something like disability insurance, 26-year-old to waiting till a 27, 28-year-old, it's not significant. It could be, 1 year could be as much as, let's say, I would say $10 a month or $125-ish a year for a female, less so for a male. The prices are lower for disability on a male. But I try, not to say that $125 is insignificant, and certainly not insignificant over the course of, 40 years paying those premiums. But I urge people to focus not so much on the money, more on the underwriting side. And for those who don't know what underwriting is, when you apply for insurance in Canada, or really anywhere, they underwrite you. They want to decide based on your health, your age, your lifestyle, if you're a good risk for the insurance company. Would they want to consider you a standard risk, substandard, a preferred risk, possibly even qualify for some better pricing? But at the end of the day, I feel, and certainly with disability, that any time that you wait where you don't have your insurance already enforced, there is a risk there. It's not a significant one. The odds of your health changing, let's say between age 26 or waiting till age 27, is minimal. And it's absolutely minimal. But if you were diagnosed with something serious, if you became a diabetic, if you suffered a minor heart attack, if you developed high blood pressure, even if you suffered a significant injury on your ski trip, those are all things that are going to make it challenging to obtain disability insurance at standard rates without exclusions. So in an example where somebody would become a diabetic, they're likely now uninsurable from a disability standpoint. In the event of a blown out ACL or MCL, the insurance company would probably issue a policy at standard rates, but there'd be a right knee exclusion on that policy. And that means that they'll cover you for anything and everything that could possibly happen to you that doesn't involve your right knee. And if you're unable to work because of that right knee, then that particular reason is excluded from you getting paid. So I urge people, while they're young, while they're healthy, to lock up that disability insurance, because once you have that coverage in force, you're protected, guaranteed, no questions asked. If you can't work for any particular reason, the insurance company will pay you.
And does that apply in a similar fashion to life insurance, for example, and the critical illness? Do you see these exponential increases or people being denied plans based on changes in the health or events that happen to them, broken limb, for example?
Yeah, absolutely, but to a lesser extent, because think about it from the insurance company standpoint. When they talk about disability or critical illness, we're essentially talking about morbidity. When we talk about life insurance, we're talking about mortality. And there's a big difference in the risk profile there for the insurers. The odds of you becoming sick or injured are far greater than the odds of you passing away. So obtaining life insurance can often be much, much easier from an underwriting standpoint, a little bit more difficult for critical illness, and much more difficult for disability.
Interesting. Okay.
Yeah. I think, Matt, it's also worth noting that in Canada, there are only 3 companies that offer what's called non-cancelable professional series disability. Okay, and what that means, I'm not going to get too technical here, but what that means is that those 3 companies, which are essentially RBC, Manulife, and Canada Life / Great West Life. Canada Life and Great West Life are essentially the same company. Those 3 companies have said, we're prepared to take an application from you, Matt, as a 26-year-old male non-smoker, ask you a whole bunch of questions about, your health and your lifestyle, and offer you coverage for the next 39 years, till age 65, without being able to change the terms and conditions of the coverage we offer you, and without being able to change the price. So they're essentially approving you today without knowing what you're going to do for the next 39 years of your life. And in contrast, just to put that in perspective, there's not a single company in the United States that will do that. There are some companies in the United States that will lock in your coverage, but they have the ability to raise the prices. Right?
Yeah.
And there's a whole bunch of companies in Canada that will also do that, have the ability to change the prices, but there's only these 3 professional series contracts that are offered by those 3 carriers that allow us to buy coverage today. And the insurance company has made their bed and has to make good on the promises that they've locked themselves into.
All right, that's an interesting point for sure. Now, if we jump into life insurance plans, is it a similar layout with a limited number of providers of such plans? And there are different terms that are thrown out there with term, permanent life insurance. Can you give a kind of segue into who provides these plans and what are the maybe 2 or 3 different types that a listener should be aware of when they start to think about a life insurance policy?
Absolutely. So I'll start off giving a little bit of foundation knowledge. When it comes to life insurance is more of a commodity because, as I just said to you earlier, it's kind of black and white. You're either alive or you're not alive. So, and there are a lot of companies all over the world, but certainly in Canada, that sell life insurance.
Okay.
But they're not entirely created equal, and we'll get into that in a couple minutes. When it comes to life, we start with what's called term insurance. Term is just a fancy word for renting. I wish the insurance industry was better with their marketing. They seem to want to confuse consumers by creating difficult words whenever possible. But term is just renting. Okay, so you can rent for 10 years, you can rent for 20 years, you can rent for 30 years. And obviously, depending on how long you want to rent for, combined with the amount of coverage you'd like to purchase, determines your price.
Mm-hmm, mm-hmm. And does it look at, your starting health and overall health as well, kind of like disability does, takes into consideration anything?
Absolutely.
Okay.
There are a few companies that do sort of guaranteed approval for very small amounts. And there are a bunch of companies that also do like a simplified application where they ask you a limited number of questions in order to qualify. But remember, if they're not asking a whole bunch of questions, then they know that they're going to get a pool of people who are not the healthiest pool, which means that they have to charge more for that insurance.
Sure.
Generally speaking, if you're healthy, you want to go with a fully underwritten, meaning lots of questions, sometimes even invasive, but lots of questions, because if you can show them that you're healthy, then you'll get the best prices out there.
Interesting. Okay. And how do you go about making that choice? Does it depend on the broker you're working with? Would they have access to all of these different types of plans and help you navigate that field?
Really good question again. So a broker or an independent advisor should have access to the entire Canadian market, and in most cases can sell from any insurance company in the country. That's my situation. There are some brokers who try to pool their business and just use 2 or 3 different companies and say, hey, I'm going to try and use only those 3 and try and put all my business through those 3 in order to sort of get stronger standing with those 3. I don't believe in doing that. I'm licensed, I think, with about 15 or so, but I probably tend to use 6 or 7 more often than the others. That just tends to be that those are the ones that come to the top of the list in terms of price and in terms of, dealing with the bigger reputable companies that have great customer service departments.
Sure. Sure.
What you want to really guard against, though, is dealing with what I would call a captive agency. So it used to be, let's say back in the 80s, where most of the insurance agents worked for a particular company. They'd work for London Life, or they'd work for Sun Life, and they would only sell those particular products. As the industry has evolved, there's still a few of those scenarios that exist, but most of the time now, what you want to do is deal with an independent person who's conflict-free, without bias, and can offer you the best coverage in any given situation. So, depending on who I'm underwriting or applying with, one day might be Canada Life, the next day might be RBC, the day after that might be Manulife, the day after that might be Sun Life, etc.
Okay.
I would say to listeners, think of it like a mortgage broker. For those who have started thinking about homes, you're unlikely these days, or less likely, I should say, to go to Scotiabank or to go to CIBC or to go to TD Canada Trust and simply put in a mortgage application. What you're more likely to do is to engage a mortgage broker. A couple of the mortgage brokers that I deal with regularly have access to about 55 lenders, and including the banks. So I'm going to deal with one person and put my trust there and let them go and source the best deal for me because they're an expert in their field.
Okay, really interesting.
And I would apply that same concept goes for insurance advisors as well.
All right. So that's a really good point and really good comparison there. Now, before we move into the next category, just to kind of revisit that topic of the life insurance there. So as long as you have a plan in place, if you die for any reason while that plan is active, it pays out to the beneficiaries you name.
Yes.
Okay. There's no limitations
Yeah.
on cause of death or anything like that necessarily.
No, what the rule in Canada is that policies come with a 2-year suicide clause. So that means that if the life insured were to commit suicide inside of 2 years from the date of issue of the policy,
Mm-hmm.
then that policy would be null and void.
Mm-hmm.
Okay, and it also comes with a 2-year material misrepresentation clause. Now, this is getting a little bit technical, but essentially, if you lie on an application, there's no date of expiry. If you lie, the insurance company has the right not to pay out.
Mm-hmm.
But in the event that you neglected to mention that you had some type of investigation or minor surgery, and you missed it in your application,
Mm-hmm.
the insurance company has 2 years on that to not pay out. As soon as it's 2 years and a day, the individual is in the clear. So they draw a line, a distinction between material misrepresentation
Mm-hmm.
and fraudulent misrepresentation.
Sure.
But other than those two situations, you can 100% rely on your policy paying out.
Okay. And then when it comes to term, you said that it's renting. So you would go and say, I want a plan to cover me for the next 10, 15, 20 years for this certain amount of monetary value that will be paid out if I die within that period of time. And after it ends, what happens? Is it just you reapply, or does the term expire and there's nothing really built up in value during that time of owning it?
It's a good question. You're getting me back on track, Matt. So anytime you buy a term in Canada, it's going to come with a renewability clause. It's going to give you options to continue the term beyond sort of the 10 years or the 20 years or the 30 years that you purchase.
Mm-hmm.
However, those options are generally not very good prices. They are your worst case scenario, your last option. What I mean by that is, you bought a 10-year term and you're at year 9.5, and you are riddled with cancer. This is an extreme example, but you're riddled with cancer, and you know that you're not going to qualify to purchase new life insurance.
Mm-hmm.
So that term that you bought for 10 years comes with some renewable rates for the 11th and 12th and 13th and 14th, et cetera, all those years beyond. And in that particular scenario, your family is probably going to help you or ask you to continue paying, because if the end is coming, even though that's an astronomical price, you're probably going to want that insurance in place, because most likely the death benefit is far, far, far greater than any of the premiums that are allotted, even in that scenario.
Interesting. Okay.
So to give you an example, let's say a 40-year-old male for $1 million on a term 10 policy might cost $35 or $40 a month. Okay.
Mm-hmm.
The rates for, let's say, years 11 through 20 in most cases might jump up to $150, $200 a month. That's a big jump.
Mm-hmm.
If you were healthy and applied as a 50-year-old male for a new term 10 years after you originally applied for the first one, I'm just off the top of my head, this is not necessarily accurate, but
for sure,
the rate might go up to $60, $65 a month, not that $200 number. But if you were uninsurable, you'd be very, very happy that you could renew, because there's a contractual right within your original purchase to have those renewable rates present for you.
And that contractual right is a default in most of these plans? Is that something that's legally stipulated as having to be included? Okay.
Absolutely. I wouldn't say it's legally stipulated, but all of the reputable companies in Canada offer it. Okay. And in fact, you can see what those rates are when you purchase your term policy. Mm-hmm. They're there and they're in writing. And but you're never going to choose to purchase your term policy based on those renewable rates. Mm-hmm. What you're going to likely do is work with your advisor and put a plan in place. And it might be a bit of a short-term plan in the interim while you're building up your practice, but you're going to either put some term insurance and potentially a staggered solution. I worked with a dentist last month, and he wanted to make certain that his family was covered for the next 40 years. And he had said to me that he wanted $2 million today on a declining basis as his children were growing up, and as his mortgage was decreasing, he wanted to have the amount of insurance decrease over time.
Interesting.
So we did in his situation was we purchased $500,000 on a term 10, $500,000 on a term 20, $500,000 on a term 30. And I think, if memory serves, we did $250 on a term 35, and we did $250 on a term 40.
Mm-hmm.
And we set him up for the long haul with some, I call it a stagger or a layering or a ladder.
Mm-hmm.
And for those who want to pay a little bit more today but lock up their insurance coverage for the long haul,
mm-hmm.
There's an opportunity to do that, and know that the price you'd pay today would be probably the highest price you'd ever pay in your life, because as policies drop off or rungs drop off the ladder,
mm-hmm.
and your coverage decreases, so does your cost.
Sure.
Right? In contrast, you could continue buying 10-year terms, hoping that you are healthy enough
mm-hmm.
to obtain insurance at standard rates. But even in that situation, if you keep repurchasing every 10 years, the price is naturally going to go up, because every time you apply, you're 10 years older.
Mm-hmm. Mm-hmm. Yeah, so it's that big advantage of applying young and healthy versus older with the uncertainty of how your health is going to be doing. Okay.
Yeah, and Matt, I think it's a good segue now into talking about permanent.
Yes, the other category that has a whole lot of other rabbit holes to go down.
So if I said that term was renting, permanent is owning. And I've said this to you in the past, I know, but if we looked at, there's a reason why term is relatively inexpensive, and that's because the vast majority of the time it doesn't actually pay out. It's protecting an individual for a particular period of time, and the insurance companies know that the odds of that individual passing away in that period of time are slim.
Mm-hmm.
In contrast, permanent insurance, if you think about it, just the nature of the word, it's permanent. All of us, we're all mortal. We all eventually die. So the mathematics behind permanent insurance are very, very, very different. About 2% of term policies actually pay out. That's, people dying within the range of the 10 or 20 or 30-year term.
Yep.
Whereas with permanent insurance, as long as you pay your premiums, 100% pay out.
Mm-hmm.
Right? We all eventually die.
Yep.
So it's a very, very, very different animal in that regard.
Now
we'll talk. I'm sure we'll talk in a few minutes about some of the aspects involved in investing within a permanent insurance policy. But what you should know is that when you own a term policy, the vast majority of the time, there's also a contractual right to convert any portion of your term policy up to the entire face amount, meaning that if you had a $1 million term 10 policy, you could convert up to that $1 million into a permanent policy without medical questions, without needing to qualify.
Mm-hmm. Mm-hmm. Interesting. Okay.
So I often tell young professionals, even if you know that you would like to put longer-term solutions in place, or you know that you'd like to purchase some permanent insurance,
mm-hmm.
if you want to protect your insurability and make sure that you're able, regardless of your health, or if you've had a scare or an investigation, the easiest way to insulate or sort of ensure your insurability, I know that sounds corny, but ensure your insurability,
yep.
is to get in the game with some 10-year term.
All
sort
right.
of the least expensive way to get in, but the fact that you're in, God forbid you get diagnosed with something serious, like I said,
yep.
diabetes, have a heart attack, a real health scare, but you survive and you're going to be here for a long time, and the odds of you being able to ever get insurance again at healthy standard rates is greatly reduced, you now have an ace in the hole.
Now, is this a feature of most of these plans, or is this something that you have to request and be aware of when you're signing up for term?
No, it's built into, when you're dealing with the Manulifes, the Sun Lifes, the Great West Lifes, the Equitables, the Empires, the RBCs, any real reputable, I'm sure I've left out a couple of carriers there, but any of the sound companies that have been in Canada for a long time, the Foresters, the BMO, they all have this embedded in their contracts.
Okay.
Yeah.
So it is something that maybe at the beginning is worth looking into. Now, in terms of the permanent term, or maybe a combination of both, can you kind of go over maybe a little more generally why an individual at a certain stage in life may choose one over the other, or a combination of both? Kind of what areas are you looking at when trying to discuss those different options to somebody?
So, generally speaking, we use term to solve a big liability, to solve a big need for a particular period of time. So an example of that, I'll use myself. This would be a great example. I'm 44 years old, happily married for, oh my God, I can't remember how many years now. I'm 13 years married. I have 2 young children, and they're 8 and 6. And at this stage of my life, if something were to happen to me, I want to make certain that my mortgage gets wiped out, that my children's education, at least their undergrad from a post-secondary standpoint, is looked after, that any small debts I have, credit cards, lines of credit, my funeral expenses, and then I'd want to look after probably my wife's income for at least a year, to give her an opportunity to look after my girls in such a horrible, if the worst were to occur. And then I have to think about this and say, hey, even if my mortgage was paid off, I want to keep my family doing the things that they love doing. I want to keep them in the same school, the same activities. It's hard for young professionals who don't have children to imagine this yet, but, my girls go to summer camp, and one of them starting overnight camp this summer, and they dance and they swim and they do gymnastics and they skate, and one of them has a tutor, and the other one's in speech pathology. And my point is that kids are expensive, and we want to keep them, in a horrible scenario like that, we want to keep them in the same, as much as we can, the same life. So in order to do that, there's no guarantee that my wife chooses to remarry, or that she is able to find someone. And even if she does, there's no guarantee that that person can earn to the same capacity that I can earn. So part of this equation is me replacing the income that I would have brought to the table, arguably for the next 15 or 20 years, or at least a good chunk of that income. And if you do the math on that scenario I just described, it's not surprising to have it come up to $2, $3, $4 million. It really isn't. So in that situation, I have to engage term insurance. To go out and buy permanent insurance for that type of figure is cost prohibitive for the average person. So, like in my situation, I have about $3.5 million of term insurance, staggered over different terms. I have some 10, some 20, some term till age 65. And then at the same time, when I'm having these conversations and doing applications for term insurance, I'm also going to look to implement some permanent. In my case, I bought an awful lot of permanent when I was young, when I was 30 and my wife was 28. But I'm a little bit of the exception to the rule. But the idea would be to have some perm and some term, is the expression we use in the industry. And that's because the term insurance insures the big liability while there's a big mortgage, while the kids are young, while you've got family to protect. But then the term isn't needed in most cases beyond 20, 25, 30 years because the kids have grown up and the mortgage is paid off and you've built up some savings, TFSAs, RSPs.
Sure.
I like to refer to it as my war chest.
Yep.
And, you don't need those millions of dollars of protection anymore, but it would be nice to have a little bit in place for the long haul because if I were to pass when my kids were grown up and my mortgage was down and I still have good retirement savings, it'd be nice to know that my wife's got an extra 250, 350, whatever the number is that I'm comfortable with.
Yeah.
And the time to apply for that amount is when you're young and healthy so you can walk into those less expensive prices.
And that would be the permanent plan that you're discussing there. The one
Yeah.
that stays with you for life. All right. Now,
And most of the time, you don't actually care so much what that number is worth today, because if God forbid something happens to you in the next 20 to 30 years, you have the term in there to protect you.
I see.
You're buying the permanent now because you want to lock it in at a less expensive price and have it there for the long haul later on when the term is already gone or fallen away.
Fair enough. Now, there is more of a build-up to the permanent life insurance plans and some of the options that you have with them. And, I definitely was eye-opening when you brought them up to me the first time. Like we talked about at the beginning, the life insurance plans in general being something that pays your beneficiary when you die. And it's just figuring out, how long do you want to be covered for, what term, for how much, or do you want to have kind of ongoing benefit that doesn't expire that you pay into in a permanent setting. But there is also more features that come with these insurance plans. So you brought up the investment side of the plans, some of the characteristics of how that can benefit you when you're alive, which is something that I think a lot of people may not be aware of. So can we take a segue into what it looks like for the permanent plans, maybe the two different kinds that we discussed, and how that looks like while you're still alive and paying into such a plan?
Well, I'll take a stab at it. It's usually it can be a complicated discussion, and usually when I'm discussing it with clients, I've got my notepad out drawing pictures, diagrams, or often when I'm doing video conference calls, I'll share my screen and I'll draw a bunch of stuff on my screen as well. But we'll take a stab at it over the phone.
Sure.
So there's two types of permanent insurance. One's called universal life, and one is called whole life. Universal life is, generally speaking, a level death benefit. The amount of the insurance does not increase. But what's unique about universal life is that the policy is permitted to be overfunded. Okay? Give you an example. I don't mind sharing my personal situation.
Sure.
When I bought permanent insurance when I was 30 and my wife was 28, I purchased universal life. At the time, I actually didn't even know or understand what whole life was. The advisor or broker that I purchased it from never educated me, and I don't know if it would have made a difference, but at this point, 14 years later, I've made my bed, and I'm still happy with what I've got. But I bought for my wife and I $1 million each permanent insurance at that stage of my life, and the cost on that insurance was roughly $4,000 a year for me and $2,800 a year for her. So my ticket price on that is about $6,800 per year. In part, I bought it because I wanted long-term life insurance in place forever. But I also purchased it because on top of that $6,800 a year, I had the ability to contribute an additional up to an additional $34,000 a year into the policy in a tax-sheltered investment.
Okay. Now, why would you over-contribute to such a plan like that?
Well, if you extrapolate out a few years, and if you've had some success in your profession, and you have a good handle on presumably your mortgage and your cost of living, you get to a point in life where you start to accumulate some wealth.
Mm-hmm.
And when you get to that point, you're doing a really good job either maxing out or contributing to the extent that you're comfortable with investing in your RSP.
Mm-hmm.
And you're most likely maxed out on your tax-free savings account, your TFSA.
Mm-hmm.
And once you get through those two vehicles, there are very, very limited opportunities to invest in a tax-advantaged way.
Mm-hmm.
So this over-contribution room that I have available to me has proven to be a really, really valuable asset, because the extra dollars that I can put in any given year, when I have the money, some years I do, some years I don't,
Mm-hmm.
I can choose the investment style of the funds, and it all grows. It's not exactly like a TFSA, but I guess I could compare it somewhat to a TFSA,
Mm-hmm.
where it all grows on a tax-exempt basis. And there are ways that we can access the money if the money is needed.
Mm-hmm.
But if the money's not needed, whatever's in that account, at the end of the day, will get paid out to my children. They're my named beneficiaries,
Mm-hmm.
on a tax-free basis over and above the $1 million in death benefit.
Okay. Now, this is putting in after-tax dollars into this over-contribution fund, and those monies are held separately from the initial permanent life insurance payout that you sign up for, right?
Yes,
Okay.
but there is one distinction to be made. When we say after-tax dollars, we're making the assumption that we've paid or we've taken out this policy on a personal basis.
Mm-hmm. Mm-hmm.
Okay? If it was a personal basis, yes, you would be paying after-tax dollars.
Mm-hmm.
However, there's a tremendous opportunity for those of us who are incorporated to buy policies that are corporately owned.
Mm-hmm.
And what happens there is that if you compare, for instance, the tax rates in Ontario, small business tax rate in Ontario is 12.5%.
Mm-hmm.
Top bracket marginal tax rate on a personal level in Ontario is 53.3%.
Mm-hmm. Mm-hmm.
So I'm now able, by owning this policy corporately, I'm able to pay with a 12.5 cent after-tax corporate dollar instead of a 53.3 personal tax rate personal dollar.
Mm-hmm. Mm-hmm. Yeah, that's huge. That's huge.
It's an incredible difference, and we're only scratching the surface. I was, Matt, I was going to bring up corporately owned policies a little bit later in our discussion. I wanted to touch on whole life as well,
Mm-hmm.
and
Mm-hmm.
then come back to the corporately owned aspect.
Sure.
Because to be honest, that's where corporately owned becomes even more popular when we talk about the second type of permanent insurance, which is whole life.
Yeah. Well, we can jump into that. We can jump into that right now, and then I was thinking of finishing up about how you can creatively access those investments within your insurance plan while you're alive, in order to take advantage of the money you've saved up. So we can jump on over to the other type of permanent life insurance, kind of the two main types there, talk a little bit about what are the kind of key overarching differences, and then those benefits of why you would want to set something like this up within, let's say, a personal corporation, and how you can take advantage of those savings while you're alive within the plan.
Okay, so whole life. You just heard me say that universal life was a level death benefit with the ability to overfund. And the amount that you can overfund, by the way, with universal life is dictated on the outset when you're applying for the policy. So you know what that overfunding room is specified to be.
Sure.
Okay, and now when it comes to whole life, it's no longer a level death benefit. Whole life essentially has a growing death benefit. It grows because there is a dividend that's declared to policy holders every year, and that dividend gets used to buy more permanent insurance. It can get a little bit technical, but at its core, the the benefit of whole life is that it's going to grow each year. Okay? Now, you're not allowed to overfund whole life. There's no additional space to put extra dollars away into the policy. But whole life on its own, just from within the premium that you pay annually, will start to build its own investment account called a cash surrender value. We refer to it as a CSV, cash surrender value. And again, this is where my drawing and notepads come in handy, but I'll do my best over the phone.
Sure.
So we typically compare and contrast these two types of permanent policies, and depending on the professional, the business owner, et cetera, depending on their needs and what they see the outlook for, the next 10, 15, 20, 30, 40 years looking like, we determine which permanent insurance solution best fits the bill. So when it comes to whole life, we can buy, let's say, $150,000 or $200,000 of whole life today as a young professional. And for the next 20 or 30 years, we know that we're just going to let it grow while our term policy protects us for the big liability. And then the term policy falls away, let's say at age 60 or age 55. And then our whole life at that point is no longer worth 200. It's worth, let's say, 400, 375, 425, whatever the number is.
Sure.
And we've also got some cash built up in there without having put in any additional monies. It might be 50, 60, 70, 100,000. It's going to depend. These policies can be quite complicated in terms of their structure, so it depends on how they're structured. But I'm giving you the foundation or the basics. So you've now got these two permanent solutions that both have a significant death benefit, and both have, assuming you've overfunded in the universal life, both have some type of investment account. Now, in order to access the money, there's a few different ways. So, I should say this with a caveat that with whole life, you very, very rarely want to access the money inside of 15 years. There's these policies take some time to sort of gather steam, to sort of build that snowball effect. So I would say that with whole life, there's a caveat that is liquidity. And liquidity is not something that you really want to get into until probably 15 years in most situations.
That's just to let it actually grow, right? Whereas in the early years, you're not going to have much of a return on that investment until it starts to compound over a significant period of time.
The death benefit is always there, but the real growth in the cash, in the investment portion, as you just alluded to, it just takes some time to ramp up. Okay. Again, I'm explaining it in a very simplified way, but it needs individual one-on-one attention for any given scenario. So the way that you access this money, typically one of three ways. You can go to the insurance company and take a policy loan. The rates on these loans are going to vary, but they're not typically great rates. I would say today probably between 6 and 8% on a loan. The advantage is that you have the money very quickly, usually within 48 hours. It doesn't hit your credit bureau. It's, you need access to cash quick, you have access to cash quick. Okay? Second way to access the money is to actually collapse the policy, to say, I don't want this anymore. Now, that has some negative implications because, number one, not only you no longer have an insurance policy, you've surrendered the policy, but the money has now also technically left the policy, which means it's no longer tax sheltered, which means that you're going to owe some money on the growth of that investment. There's tax implications. So it's not typically one that gets used very often. The third and most common way to access the money is through collateralizing the policy. Or assigning it to a financial institution. So the banks love, in particular, whole life policies because they're they're very, very solid investments. They're pretty bulletproof. And typically what they'll do is they'll lend against the cash value, 90% of the cash value at prime.
Wow.
And it's a great way, if need be, again, if needed, to access those dollars without having tax consequences.
Yep.
And, essentially keeping your policy going while still having access to the cash. And then let's say, for argument's sake, there was, let's say there was $300,000, $400,000 in cash, and you went and accessed $200,000 of it, and the death benefit was $1.2 million. And then you passed. What would happen in that scenario is, of the 1.2 in your death benefit, 200,000 would go back to the bank to pay off the cash that you borrowed, and 1 million would get paid to your named beneficiaries on a tax-free basis.
Very nice. So, as a professional now, a couple of years into my career, I set up my own. I incorporated. I'm sheltering some money in my corporation at a tax advantage rate. I could go ahead and set up one of these insurance plans with either the ability of the insurance plan to invest some of my premium that I'm paying in each month and grow for itself over the years, or over contribute to one of these funds and go ahead and try and steer maybe my investments myself a little bit and dictate how much more money I can put in each year based on my over contribution limit. And at some point later in life, if I've accumulated this kind of side reserve of cash within my insurance plan, I would be able to, if I needed to, for example, or I wanted to make one big purchase, for example, go and borrow against that cash value, potentially at prime, depending on the plan, and still have that cash left in the plan itself, basically accumulating more interest in the investments that I have it in. And then I could choose to pay back that money as needed over time. Or if I don't, it would just no longer be something that gets paid out to my beneficiaries if I should pass away.
You're listening very well, I can tell. You paid attention to our last call.
Yeah.
You've got it fairly accurately. When it comes to professionals and even business owners, I hear the same thing over and over. Business is doing well, but they're a little bit unsure of, putting money that's sitting in the corporation, the retained earnings in the corporation, into the markets. Number one, markets are volatile. And number two, those dollars are taxed as passive income. What I mean by that is, if you have corporate dollars that you're only paying that small business rate on, that 12.5% in Ontario, and then, let's say, Matt, you're doing well and you've saved up $100,000 in your corp, and if you want to go and invest those dollars, you're going to have stiff tax implications. You're not going to be able to only pay 12.5% tax on those invested dollars. So then you say to yourself, well, why would I take on risk and have to give, 50% back to the government, or have my small business tax rate clawed back, which was a new introduction that the Liberals introduced in the last budget. So you start to think to yourself, well, I'm just going to put it into a high interest account and make 2.5%, 3%, and let it sit there, and that's my solution. That's why this corporately owned life insurance can become an incredible asset to the portfolio. And I say portfolio because advisors today speak in terms of diversification. And it's important when you're talking about diversification to acknowledge the fact that life insurance as an investment is another asset class. So what I mean by that, and Matt, tell me if I'm getting too technical for the listeners, but
no, it's good so far.
What I mean by that is, when you think about your portfolio, you're talking about your traditional investments, your equities and your fixed income. Okay. You're talking about your business. So in your case, that's practicing optometry.
Yep.
You're talking about real estate, potentially. So if you own your own practice, or the building that you practice in, or if you're a landlord or anything like that, you've got real estate.
Mm-hmm.
And then the last asset class is actually life insurance. And the reason why all of these are separate asset classes is because they all grow and accumulate in different manners. They are all accessed from a tax standpoint in different manners. And they all behave differently in different markets. One of the things that's nice about a whole life policy, as an example, is that both the death benefit and the cash surrender value, the investment aspect, are what's called what's called vested.
Mm-hmm.
Sorry, I almost forgot the term for a moment. Vested means that the minute that dividend is declared and you as the policy owner are told that you have X amount of death benefit and X amount of cash value, because this is first and foremost an insurance policy, they are never, ever allowed to tell you that it's worth a penny less than they told you it was earlier.
Mm-hmm.
So the best example I can think of is that when 2008 happened and most people who were invested aggressively in the markets lost 35, 40% of their portfolios, where did they go into? Where did they get money? Where did individuals find money to go buy back into the market at a low point?
Mm-hmm.
This was a great source of funds. People went in to their whole life policies because whole life policies had not lost a cent.
Mm-hmm.
And they went and they either collateralized or they took policy loans. They bought back into the market at a great point to buy.
Mm-hmm.
They watched over the next 12 to 18 months the market recover, and they made a ton of money back.
Mm-hmm.
And as soon as the dollars were where they need them to be, they took the dollars out of the market and paid the whole life policies back.
Yeah. Great point.
Right.
Great point.
Yeah, Matt. The other thing worth noting, and I know we're belaying a little bit on whole life and on permanent insurance, but there's a reason why uber wealthy billionaires use whole life insurance. They don't need insurance,
Mm-hmm.
right? They've got billions of dollars.
Sure.
But these policies are the single smartest, most tax-efficient tool to transfer wealth to the next generation. So, perfect example I can tell you is I met with a 45-year-old dentist several weeks ago,
Mm-hmm.
him and his wife, doing quite well, owns some real estate, does very well in his professional corp. Had the same concerns that I was just telling you about. Has money sitting in the corp, can't get the money out without paying huge tax on the money.
Mm-hmm.
Wanted to put some of the money to work.
Mm-hmm.
What we ended up doing in his case, and this is the tip of the iceberg in terms of the types of strategy that we can use. But his goal, he had 3 children. He wanted to make certain that he was looking after the tax bill for when the properties eventually changed hands that he has in his portfolio. But he also wanted to make sure that at life expectancy, he was going to leave each of his children at minimum $2 million.
Mm-hmm.
What we ended up doing in his case was taking him and his wife and putting together what we call a joint last to die whole life policy. And what that means is that there's 2 lives on the policy, but there's no payment triggered on the first death. There's only a payment triggered on the second or the last death.
Mm-hmm.
And why do this? Because when we take a 45-year-old male non-smoker and we take his wife was 43-year-old female non-smoker, and we sort of blend them up as one person from an actuarial standpoint, they became a 28-year-old androgynous person.
Mm-hmm.
And then we bought a policy on a 28-year-old.
Mm-hmm.
So we saved a ton of money. We got better value. He wasn't concerned about protecting him and his wife because they had other term coverage
Mm-hmm.
individually owned to protect that risk.
Mm-hmm.
This was simply a structure for him to make good use of the dollars in his professional corp.
Yeah.
And to make sure that there's wealth being transferred to the children.
Yeah.
Right?
Okay, yeah, it's really interesting, yeah.
So, tip of the iceberg, there's again, there's only so much we can discuss over the phone, but there's lots and lots of creative ways to address different concerns and to mitigate risk and to minimize tax. And this is some of the stuff that I like doing the best in my practice, because it's when you really get the creative juices going and really get to sort of solve problems and I don't want to say beat the tax man, but at the same time, successful people generally would prefer to leave as much as possible to their families or their charities of choice, and as little as possible, typically to the federal government. And insurance can really, really help do that.
And that's where I think it's definitely important to note that everybody's individual situation is going to be vastly different from other people's, and speaking with a professional is something that you really need to do to figure out your situation and what's the best options that you should be considering. Now, with that in mind,
I'm going to interject for one moment and just say two things that you can really watch out for. This is a cautionary tale for listeners.
Sure.
Any advisor who's coming in and sort of pitching you an idea, if you will, or throwing everything against the wall and seeing what sticks. That's something to watch out for. I feel that a quality advisor is going to ask you a ton of great questions and spend the majority of their time listening to you. Because by listening, that's how we determine what product is going to help solve challenges that you have, accomplish goals that you're looking to achieve, etc. If you've got somebody that is trying to ram an idea down your throat, or trying to tell you that, you have so much retained earnings in your corporation, you need to put X amount into a life insurance policy, to me, that's a big red flag. And remember, as good as these things sound, they are not the best thing out there. They're extremely, extremely useful and can be incredibly efficient at accomplishing a particular task. But I never recommend somebody putting all of their savings into a permanent life insurance policy. You allocate a small percentage that makes sense in the larger picture.
Sure. You bet. Now, if the listeners have follow-up questions, or they would want to get in touch with you based on the information and some of the value of the information you provided today, would you be open to getting inquiries or emails? Is there a way that somebody can contact you most effectively in order to open up a conversation about some of these items and seeing if they can learn a little bit more from you?
Of course. I'm always open to hearing from, whether it's just sharing my knowledge or, potential for a new client. I would suggest start off by checking out my website, www.boldfinancial.ca. That's boldfinancial.ca.
All right.
I can be reached at david@boldfinancial.ca. There's also links on the website.
Sure. And we'll provide some in the show notes there for any interested parties. So thanks so much for coming on, David. It was a great chat. I think we definitely went into a little bit more depth on some of the topics that a lot of people might not be aware about and might want to start considering right now at certain stages of their career, or maybe opening up those discussions with a trusted advisor. And I think that is pretty much a wrap. Thanks for listening to this episode of Between Two Temples. Visit us at optometricinsights.com, where you can find show notes and other great resources. If you like the show, give us a review on your preferred podcast app and be sure to subscribe. It helps us reach more listeners and deliver better content with more great guest interviews. Happy listening.